Hello guys, I believe audio and video is clear to all of you. Can you please comment in the chat box? Come on guys, can you please all of you comment in the chat box and do let me know if the audio and video is clear to all of you. Come on guys. Come on, fast, fast, fast. Wonderful, wonderful guys. Now, so in the last session, we revised IAS 16 property, plant and equipment. So today, first of all, we'll be revising IAS 40 investment property, a quite very easy going standard. So let us revise in very fastly. Let us revise very fastly. Now, IAS 40 deals with investment properties, deals with investment properties. Now, first comes the question, what exactly is the meaning of investment property? So I believe in the last class, it is yesterday's class, day one of this session, we already discussed the meaning of investment property. But still, let's reiterate the same, let's rediscuss the same. What is investment property? So investment property is land, building, both or a part thereof. Now, when I say land, I mean to say only land. When I say building, I mean to say only building. When I say land and building both, I mean to say a property which is built on a land and we own the land and the building both. Now, fourth one is part thereof. What is the meaning of part thereof? What is the meaning of part thereof? So part thereof basically means, let's suppose there is an apartment, in that we own a floor. We own a floor, that is called a part thereof. So what is investment property? Investment property is land, building both or a part thereof, held for either rental to others or for capital appreciation or for both. These are called as investment properties. But now understand, let's suppose I have a property, that is land, building both or a part thereof, but I have held these properties for, let's suppose, production of goods or supply of services. Will that classify as investment property? No. If the property is held for production of goods or supply of services or administrative purposes, then it is not a investment property, rather it will be classified as property, plant and equipment. Okay, see, that's what I have written here. If a property is held for rental to others or capital appreciation or both, these are called as investment properties. But if a property is held for production or supply of goods or services, admin purposes, then it is called as property, plant and equipment in the scope of IAS 16. If it is held for sale in the ordinary course of business, it is called as inventory. It is called as inventory in that case. And if it is held for sale, it is classified under IFRS 5, that is non-current assets held for sale. So this is what is the classification of investment property. Now let me tell you one point, guys. The theme of three standards are more or less the same. The theme of three standards are more or less the same. Which are those three standards? Which are those three standards? Property, plant, equipment, investment property, intangible assets. The theme of these three standards are more or less the same. So before moving on to any further discussion, I want to discuss what exactly are the similarities or the differences between these three standards. So let us discuss with it. A comparative analysis sort of thing. Property, plant, equipment, investment property, intangible assets. So it is covered under IAS 16, it is covered under IAS 40, and it is covered under IAS 38. Okay, let us understand the differences between these differences or the similarities between them. Now, definitely the meaning part is different for each of them. If I talk about property, plant, and equipment, if I talk about property, plant, and equipment, so property, plant, equipment is any tangible asset, any tangible asset held for production or supply of goods or services or admin purposes or rental, and the life is greater than one period, then it is called as property, plant, equipment. But understand, when I say rental to others, I exclude the rental of property, because if a property is given rental, it is called as investment property. So now here I will say the definition of investment property is property that is land, building, both or a part thereof, held for rental or capital appreciation or both is called as investment property. Now, what is the meaning of intangible assets? What is the meaning of intangible assets? So intangible asset basically means any asset which does not have any physical substance, no physical substance, plus non-monetary, okay. Now, which satisfies three criterions. What are the three criterions? Control criterion, identifiability criterion, and benefits criterion. This is called as intangible assets. The meaning of intangible assets I will discuss again in depth in the chapter of intangible assets. But yes, this is the meaning of intangible assets. Now, moving further, guys, trust me, this comparative analysis will be one of the best thing which you will study. Okay. Now, basically, with one level of energy, you will be able to understand three standards at one go. Going further, then comes the next topic. What is the recognition principle? Recognition principle. So recognition principle is future economic benefits are probable plus cost can be measured reliably, and the same recognition principle applies here, and the same recognition principle applies here. So this is recognition principle. Now comes the next, measurement principle. So first is initial measurement. Initial measurement should be at cost, and the same principle applies here. And one thing, the meaning of cost is same for all three. What is the meaning of cost? Purchase price plus non-refundable taxes minus trade discounts or rebates plus borrowing cost under IAS 23, that is borrowing cost in qualifying assets, plus any directly attributable cost incurred to bring the asset in the intended location and condition, plus present value of decommissioning, removal or restoration costs. Okay. Now, under directly attributable cost, we do capitalize testing cost, we do capitalize initial handling, transportation or installation costs. Okay. Now, this is initial measurement. Coming to subsequent measurement. So subsequent measurement, we have an option of cost model or revaluation model, and this option of cost model or revaluation model is available on class of asset basis. Further, if you opt for a revaluation model, okay, first of all this one. Now here, Under investment property, again, there is an option for cost model or revaluation model, but it does not apply to all class of assets. It says entire PP, entire investment property is a class of asset. Hence, either full, either all investment properties either at cost model or at a revaluation model. There is no such concept of class of assets in the case of investment property. Now, here do, and here again intangible assets, we have again class of asset basis. But in intangible assets, we have a disclaimer again. We have a disclaimer again. What is a disclaimer? For intangible assets, entity can apply a revaluation model. Entity can apply a revaluation model only if active market exists, only if active market exists for that intangible asset, only if active market exists for that intangible asset. Clear, everyone? Now, next topic. Let me add one more page. Guys, tell me, don't you think this comparative analysis is actually helping you? Tell me, guys, come on. Don't you think this comparative analysis is the best way of studying? It is property, plant equipment, investment property, intangible assets. Right now, further. So we have done till here. Now again, if we have opted for a revaluation model, then if we have opted for revaluation model, so standard says frequency is generally once in 3 to 5 years. Frequency is generally once in 3 to 5 years. Okay. Now, but if you opted for a revaluation model of investment property, then in that case, revaluation has to be done annually. Okay. Here in intangible assets, again, it is same. That is, it has to be done once in 3 to 5 years. Now, if we opted for a revaluation model, then in that case, revaluation gain or loss has to be accounted for in other comprehensive income for property, plant, equipment and accumulated in revaluation reserve. But if you opt for revaluation model of investment property, the revaluation gain or loss will go where? It will go to P and L. It will go to P and L. It will go to P and L. Similarly, for intangible assets, you will record the revaluation gain or loss in other comprehensive income and accumulate in revaluation reserve. So this is about revaluation model. Now, coming to cost model. So cost model is original cost minus any depreciation. And the same rule applies here for investment property and the same rule applies for intangible asset. Okay. Now, further, derecognition. So on derecognition, we pass the journal entry, bank account debit to asset to gain or loss will be sent to P&L, and the same entry is passed on disposal of investment property. Same entry is passed on disposal of intangible asset. So basically, we have done the entire discussion. Of property, plant, equipment, investment property and intangible assets on a comparative basis, which I believe definitely will help you understand the topic in depth. Tell me, guys, is that clear to all of you? Come on, guys. Is that clear to all of you? Okay, now let us discuss here. Let us come and discuss here. Now, understand, please. So we have discussed the meaning of investment property. Going further, what is the classification of investment property? So now understand, if there is a property, which is held for use in production or supply of goods or services or admin purpose, it is called as in property, plant, equipment. Held for sale in ordinary course, inventory. Held for sale, IFRS 5. Held for rental to employees, then under IAS 16. Held for capital appreciation or rental or both, then investment property. Now comes the main point here. Let's suppose I have a property. The use of which is undetermined. I don't know for what purpose I want to use. See, understand, if the purpose is determined, that is rental, sale, use, okay, if it is determined, then definitely we can do the classification. What if we don't know what exactly, how exactly we want to use this property for? Then in that case, what will happen? So standard says, if the purpose is undetermined for a property, it means you have taken that property for capital appreciation, and the classification will be investment property. Now, recognition principle for investment property, as I mentioned, it is exactly the same as that of property, plant, equipment. That is, recognition principle is exactly the same. That is, future economic benefits are expected to flow to the entity, and cost has to be measured reliably. If both these conditions are satisfied, then yes, we can recognize the investment property in the financial statements. If either of these conditions are not satisfied, then whatever amount that we have spent on investment property will be expensed off to P&L. Now, moving further, the measurement principle. Guys, come on, tell me, are you understanding? Is everything clear till here? Is everything clear to all of you till here? Wonderful. Now, moving further. Measurement principle. So measurement principle again has two measurement principle, that is initial measurement and subsequent measurement. Okay. Now, initial measurement is done at cost. What is the meaning of cost? The meaning of cost is exactly the same as that of property, plant and equipment, right? Now, coming to subsequent measurement. So subsequent measurement can be done at either cost model or revaluation model. Okay. Now, the cost model is exactly same as that of property, plant, equipment. Depreciation is also same as property, plant, equipment. There is no difference in that. Okay. Now, watching from Pakistan, watching from Azerbaijan, all of you, welcome to our revision batch. Now, revaluation model. Now, this is a catch here. I am highlighting here. This is a catch. Revaluation model is a catch. This is something different. Now understand, under property, plant and equipment, what we did. Okay, so therein, whatever was the revaluation, if entity opted for a revaluation, standard said that revaluation model has to be applied on class of assets basis. What is the meaning of class of assets? Assets of similar nature and similar purpose are grouped into a class of asset. Now understand, for this investment property, what is the nature of the asset? Land, building, both or a part thereof. So all the assets are of same nature. What is the purpose? Investment. So the nature and purpose of all the properties of investment property is same. So entire investment property itself is one class of asset. So if entity wants to adopt cost model, it has to apply cost model to all investment property. If entity adopts revaluation model, entity must apply revaluation model to all investment properties. It is here students generally make a mistake, so please don't make a mistake now here. Okay. Now, going further, if entity adopts revaluation model. So here revaluation has to be done annually. Guys, please understand here, for revaluation model, revaluation has to be done, point number 1, annually. Point number 2, any revaluation gain or loss will be recognized in P&L. And point number 3, if you opt for a revaluation model of investment property, there is no depreciation to be charged. There is no depreciation that you will recognize. There is no depreciation on investment property. Why? Because if you are doing annual valuation, depreciation already gets accounted for. You are not required to specifically account for depreciation again and again and again. Is that clear, everyone? Tell me, guys, come on. Is that clear, everyone? Okay, no specific depreciation in that case. Okay, now standard also goes on to state, let's suppose if you have opted for cost model of investment property, in that case you must at least disclose the fair value of investment property. Okay, all entities must measure and disclose the fair value of all investment properties. Okay, now, so this is about investment property. Now comes a very important topic, transfers. Guys, trust me, if you see a question on investment property in the exam, if you see a question on investment property in the exam, it is 90% probable that it will come from this topic. 90% chances that the question will come from this topic, transfers. Okay, now what is the meaning of transfer? What is the meaning of transfer? Understand. Earlier, okay, so far we were using the property. So far we were using the property for administrative purposes. Okay, but now I don't need the property for my admin purposes. Now I want to lease the property, that is, give it on rental to others. So what happens? When it was used for admin purpose, it was property, plant, equipment. But when I will give it on rental to others, it will become investment property. So what will happen? The same property, but the use changes. Same property, but the use changes from property, plant, equipment to investment property. Okay, so it can be a property, plant, equipment to investment property, or vice versa, that is investment property to property, plant, equipment. It can be anything in the example. Okay, now, so what standard says here? Okay, when do we need to do the transfers accounting? So standard says we have to do the accounting when property use is changed and there should be an evidence supporting the change of use. What is the meaning of evidence supporting the change of use? So far the property has been used for admin purposes. Okay, but now I want to give it on rental to others. Okay, just that entity has thought this thing. Will we apply transfer accounting? No. There should be, this is the change of use, but there should be an evidence supporting the change of use. What should be the evidence? I have started vacating the property and I am actively looking for lessees. I'm actively looking for tenants. I'm actively looking for tenants. So this is an evidence supporting the change of use. So when the use changes and there is an evidence supporting the change of use, we apply transfer accounting. We apply transfer accounting in that case. I believe it is very much clear to all of you. Now comes the question, how to apply transfer accounting? So for that standard says, I am giving you a very simple rule. If you remember that rule, you will be able to apply any given scenario. Let's suppose this is date of transfer. This is date of transfer. So standard says that till date of transfer, you will apply old classification accounting. Subsequent to date of transfer, subsequently, you will apply new classification accounting. This is the simple rule. Now, To meet this, there can be 8 possible cases. What are the 8 possible cases? Just see here. I have made a list of all the 8 possible cases. See, understand. First 4 case, if you just see, it is PPE to investment property. The next 4 case, if you see, it is investment property to property plant equipment, right? Right? But now let us see further. So now understand, first case is property plant equipment cost to IP at cost. Second case is PPE at cost to IP at fair value. Third case is PPE at fair value to IP at cost, and PP at fair value to IP at fair value. So basically what I have done is I have tried to list all the possible cases, and I'll take up an example and explain all the 8 possible cases with you guys so that you have a absolute clarity on this topic, because I don't want you to mess up on this topic in the exam, because this is one of the most important topic in the investment property chapter. Now when you will watch the practice session of investment property, you will see I have solved almost all type of questions which are available to us from a transfer accounting perspective. Okay, now if you want to see, I'll show it to you. Just give me a minute, please. Just see investment property. See, we have solved a lot many questions on transfers. See, transfers discussion here. See here, almost all the questions which we have done is on the basis of transfer accounting, transfer accounting, transfer accounting, again transfer accounting. So basically we have done a lot many questions on transfer accounting to give you a fair understanding of the transfer accounting questions. Now understand, if PPE is at cost, transfers to IP at cost. Now understand, cost model of both PPE and IP is same, right? It is same. So will there be any change in the measurement? No, no change in measurement, just the name will change from PPE to IP. But understand, PPE is at cost. So here on date of transfer, PPE will be at carrying amount, but IP is at fair value. So you will transfer it to IP at fair value. Now here you will get some revaluation gain. Now what I have mentioned, till date of transfer you have to apply old classification. What was the old classification? Property plant equipment. Under property plant equipment, where do you recognize revaluation gain? Other comprehensive income. So this will be recognized in other comprehensive income and accumulated in revaluation reserve. Okay, now subsequently, since IP is at fair value, any fair value gain or loss will be recognized in P and L. Clear, everyone? Now similarly, IP is at fair value to PP is at fair value to IP at cost. So understand here, on this date, on the date of transfer, PPE will be at fair value. Now this fair value becomes cost of investment property, becomes cost of investment property. Understand, any fair value gain or loss till this date was recognized in other comprehensive income and accumulated in revaluation reserve, because PPE was at fair value. Since subsequently IP is at cost, there is no fair value gain or loss that will be recognized. Okay, now subsequently, PP is at fair value to IP at fair value. So understand here, no change in measurement. No change in measurement. But understand, here when PP was at fair value, you were recognizing the revaluation gain loss in other comprehensive income. Okay, were you doing annual revaluation? No. So here what will happen? Here what will happen? You will record revaluation gain or loss in P and L. Then you will do annual revaluation. Then no depreciation. Since IP is at fair value, no depreciation, no further depreciation. No further depreciation. Clear? Now, further, IP is at cost. Now, first four cases gets over from PPE to IP. Now we are starting the next four cases wherein we are transferring from IP to PPE. So understand, these four cases where PPE to IP. The next four cases are IP to PPE. Understand here. IP at cost to PPE at cost. So no change in measurement because cost model of both is same. Just the name changes. Clear? Further, IP at cost to PPE at fair value. So here what will happen is IP will be at its carrying amount, but PPE has to be recognized at fair value. And here you will get revaluation gain or loss. And what I have said, till date of classification, we apply old classification accounting till date of transfer. So what is the old accounting? IP. And in IP, where do we recognize revaluation gain loss? P and L. So this will be recognized in P and L. But here any subsequent revaluation gain or loss will be recognized in other comprehensive income and accumulated in revaluation reserve. Further, IP at fair value to PP at cost. Now what will happen? So understand here, please. PPE, sorry, not PPE, IP. IP will be at fair value, and this fair value will become cost of property, plant, equipment. Now further, please understand, till date of transfer, any fair value gain or loss will be recognized in P and L. We did annual revaluation and we didn't charge any depreciation, but subsequently no fair value gain loss. Further, we will depreciate the PPE over its useful life. Clear, everyone? Now further, the last situation. IP at fair value to PP at fair value. So transfer will happen at fair value. Transfer at fair value. But only thing which you need to understand is before date of transfer or the till date of transfer, since IP is at fair value, we will do annual revaluation. Any fair value gain or loss that comes up will go to P and L and no depreciation. Okay. Now further, after date of transfer, subsequently what will happen? Will we do annual revaluation? No annual revaluation. No. Will we record revaluation gain or loss in P and L? No. It will be recognized in other comprehensive income and accumulated in revaluation reserve. Depreciation has to be charged. Depreciation has to be charged. I believe you have understood all these 8 cases. If I have to quickly summarize these 8 cases, I will say only a simple line. Till date of transfer, apply the old classification accounting. Subsequent to date of transfer, apply the new classification accounting. Is that clear to all of you? Come on guys, tell me. Is that clear to all of you? Okay. Now understand the last point. change in classification of the property is due to change in use. Okay, and when the use changes, it's a change of estimate and not a change of accounting policy. It's a change of estimate. It's a change of estimates. It's not a change of accounting policy. It is not a change of accounting policy, and hence it has to be accounted for prospectively. That's why I said till date of transfer old classification accounting, subsequently new classification accounting. Whatever has happened has happened. Okay, now derecognition principle is exactly same as property, plant and equipment. That is, when do we derecognize investment property? When it is disposed of, or when there are no future economic benefits available from the investment property, we derecognize the investment property. Okay, whenever we derecognize the investment property, what happens? We derecognize at its carrying amount. If we have disposed of and received some sale proceeds, that has to be recognized. Any difference has to be recognized in P and L as gain or loss on sale of investment property. I believe it is very much clear to all of you. Now, exam focus point, the mistakes which you can do in the exam. Understand, in subsequent measurement, always remember that the revaluation gain or loss will go to P and L only. One more point, if the investment property is at revaluation model, always remember no depreciation has to be charged. Okay, now transfer accounting has to be applied when there is a change of use, plus there is an evidence supporting the change of use. Okay, and transfer is a change of estimate, not an accounting policy. I believe it is very much clear to all of you. Anyone having any queries in investment property? Okay. So this completes our investment property discussion. Come on guys, are you understanding? Please give me a heads up. Are you understanding everything? All of you, please do like the session. Please do like the session, all of you. Come on guys. Okay, chalo. Let us start a new standard, that is IAS 38 intangible assets. Sir, almost all of the intangible assets we have already revised. Almost all of the intangible assets. Sir, where? Just now here, as part of comparative analysis, we did revise the entire intangible assets, right? So let us revise it again quickly and wrap it up. Okay, let us quickly revise intangible assets again and wrap it up. Why I'm saying again, because we did already have done a comparative analysis of intangible assets, right? A comparative analysis of property, plant, equipment, investment property and intangible assets, right? Now comes the first point. What is the meaning of intangible assets? So intangible asset is ideally a asset which does not have any physical substance. By the name itself says intangible, which does not have any physical substance and which are non-monetary, are called as intangible items. But this intangible item will be called as intangible asset if it satisfies these three criterion. What are these three criterions? Understand. First one is identifiability, then comes control, and then comes benefits criteria. So let me discuss these three criterions. Understand, this mobile phone, it is a tangible or intangible? Come on guys, tell me. This mobile phone which I am holding, it is a tangible or intangible? It's a tangible asset. Do I need to specifically identify? No, I can identify it already. But understand, in my phone, let's suppose I have a software called as WhatsApp. Okay, that is an intangible. Does that have any physical substance? No, it is intangible. So I would need to evaluate whether that WhatsApp is identifiable or not. It is identifiable or not. Okay, it does have its own identity or not. So how will you check the identifiability of an intangible asset? So for that, standard says if the entity has a right to separate the intangible from itself, it is identifiable. It is identifiable. How will we check if it is separable or not? So standard says if the intangible can be sold, transferred, rented, or exchanged separate from the entity, then it is separable. If it is separable, it is identifiable. Okay, now standard also further goes on to state that even if it is not separable, but it arises from a legal or a contractual right, it arises from a legal or a contractual right, then also it is identifiable. Let me give you an example of it. Let me give you an example of it. Okay, now let's suppose let's suppose I have a software which I got it developed from Infosys. Okay, I have got a software developed from Infosys or Google. Okay, I have got a software developed. Now that software I used for some time. Then I think, okay, this software is no more of use to me. I want to sell that software to my friend. Can I do that? Yes, I can very well do that because I had the ownership of the software. Because I had the ownership of software. So that software is separable. Hence it is identifiable. Hence it is identifiable. Hence it is identifiable. Okay. Now, further, let's suppose government has given me a right to operate. Government has given me a right to operate in a particular locality. Tell me, can I transfer it to my friend? Can I transfer it to my friend? No, I cannot transfer because government has given that right specifically to me. I cannot transfer it to someone else. Let's suppose government has given me a license to drive a bike. Can I transfer that license to someone else? No, that license is not transferable. That license is not transferable. So it is not separable. But standard now also goes on to state, even if it is not separable, but if it arises from a legal or a contractual right, then also it is identifiable. Now this license which government has given me to ride a bicycle, it arises from a legal right. It arises from a legal right, right? So still it is, even though it is not separable, still it is identifiable. Still it is identifiable. Now, second point comes control criterion. What is the meaning of control? Control means the entity has the right to use the asset. Okay, or and entity has the right to direct the use of the asset, and entity has the right to receive all the economic benefits from the asset. Okay, let's suppose if I say I have this software, I have a software in my phone. Let's suppose. Okay, I have the ultimate right to direct the use of that software, and no one else can use that software. No one else can use that software. Only I can use that software. Now, from that software, whatever benefits will come to me. Tell me who controls the software? I control the software. I control the software. I control the software. Benefits criterion. The intangible should give me some or the other economic benefits, whether it is direct economic benefits or indirect economic benefits, but economic benefits should be there. Economic benefits can be in the form of increased revenue or decreased costs. It can be in the form of increased revenue or decreased costs. Okay, both are called as benefits. So if an intangible item satisfies these three criterion, we say it is an intangible asset. I believe it is very much clear to all of you. Come on guys, please confirm. Further, recognition principle. Recognition principle, as I have mentioned, recognition principle of PPE, investment property, intangible asset, is same. What is the recognition principle? It is probable that future economic benefits will flow to the entity and cost can be measured reliably. If both the conditions are satisfied, yes, we can recognize the intangible asset in the books of account. If we can recognize the intangible asset in the books of account and amortize it over its useful life. If either of these conditions are not satisfied, then whatever amount we have incurred to purchase or acquire that intangible item will be expensed off in P and L. Now coming to measurement principle. Under measurement principle, initially the intangible asset will be measured at its cost. The meaning of cost is exactly the same as that of property, plant and equipment. That is, purchase price plus non-refundable taxes or import duties minus trade discounts or rebates plus any borrowing costs. Sir, how will be borrowing cost be capitalized in this case here? Let's suppose, just give me a minute, please. Okay, now let's suppose what happened is Zomato or Amazon, forget about Zomato, Amazon has hired a team of software developers, to develop the Amazon app, okay. Now this process of development of Amazon app will take significant amount of time. Hence the Amazon app will be qualified as qualifying asset, and hence any borrowing cost incurred in the period of development of the Amazon app will be capitalized to the cost of Amazon app. Okay. Now, plus any other directly attributable cost incurred, plus any testing cost incurred, plus any installation cost incurred. Okay. All those will be capitalized to the cost of the asset. Now, subsequently, how will we measure? So, subsequent measurement can be done as per cost model or revaluation model. Okay. Now, understand please. Subsequent measurement as cost model or revaluation model. The same principle was discussed as part of property, plant and equipment as well. And the same thing we are discussing here as well, right? Exactly. So let me give my inputs here. Entity can apply subsequently cost model or revaluation model, okay, on a class of assets basis. What is the meaning of class of assets? Assets of similar nature and similar use are grouped into one class of assets. Sir, but all intangible assets, don't you think is one class of asset? No. Their nature might be different. For example, software is one type of intangible asset. Patents is one type of intangible asset. Copyrights, trademark, brand name, right? There are other nature of intangible assets. There can be any other types of intangible assets, multiple type of intangible assets. Their nature might be different, their purpose might be different, right? So we can have multiple class of intangible assets. Okay. Now on the class of assets basis, we can decide whether we have to use cost model or revaluation model. But standard says, while deciding the revaluation model, we have to be mindful that we can apply revaluation model if and only if there is an active market for that intangible asset. There is an active market for that intangible asset. Now, what is the meaning of active market? Asset is sold with sufficient volume and frequency. Okay. Now, I do have a question on this, though in my practice session, I have already discussed that question, but still I want to discuss it again now. Just give me a minute, please. Intangible assets. See the question. Sagan Co acquires a brand name with an estimated life of 10 years for 10 million. On 1st Jan 2005, a brand specialist believed the brand to have a fair value of 14 million. Tell me, can we opt fair value model or the revaluation model for brand name? Can we? No. Why? Understand. Do you think brand name has an active market? Do you think brand name has an active market? No, brand name does not have an active market. Do you think brand name of Zomato is actively traded in the market? Brand name of Google is actively traded in the market, or brand name of Microsoft is actively traded in the market? No, my dear friends. No, no, no. So since there is no active market, hence we cannot apply fair value model for these intangible assets. Okay. Now there is one statement being said here. Let me read that statement first of all and explain it to you. If an intangible asset in a class of asset that follows revaluation model cannot be revalued because there is no active market for this asset, then asset is carried at cost model. What is the meaning of this? Let me explain. Let's suppose we have a class of intangible assets as brand name, copyright, and trademarks, software. Okay. Now understand please. We have brand name 1, brand name 2, brand name 3, brand name 4, and this brand name is at cost model. Why? Because brand name we know explicitly that there is no active market for it. Copyright and trademark are also at cost model. Copy 1, copyright 2, copyright 3, trademark 1, trademark 2. Now software is software 1, software 2, software 3, software 4, software 5. Now understand, all these brand name will be at cost model. This will be at cost, this will be at cost, this will be at cost, this will be at cost. Let me write that. All of these should be measured at cost model. All of these should be measured at cost model. And all of these, since it is at a revaluation model, hence all of these should be measured at revaluation model. Sir, we already knew this. What is new that you are teaching? Let me explain. So understand, although all the software will be under a revaluation model, but if entity is of the opinion that for software 3 specifically, no active market, then even though the entire class of asset is at revaluation model, still S3 will be at cost model. Still S3 will be measured at cost model. Now you read this statement and you will understand the meaning of it. Where is it? Yes. If an intangible asset in a class of asset that follows revaluation model, if an intangible asset in a class of asset that follows a revaluation model cannot be revalued because there is no active market for this asset, then the asset is carried at cost model. Are you understanding this statement? Come on, guys, tell me. Are you understanding this statement? Come on, guys, please tell me. Is that clear to all of you? Guys, this is one of the most important points, okay, which ACCA can definitely ask in the exam, but students generally tend to ignore these statements. Is it clear to all of you? Wonderful. Now, frequency of revaluation is same as property, plant, equipment, but still let me tell you what is the frequency of revaluation. So intangible assets has to be revalued when the carrying amount of intangible assets differs materially from its fair value. Generally, we have to do once in 3 to 4 years, 3 to 5 years. If the fair value of intangible asset is significantly volatile, then annual revaluation can also be done. Okay, now what is the treatment of revaluation gain loss? Exactly same as property, plant, equipment. So first time revaluation gain, other comprehensive income. Second time revaluation gain, other comprehensive income. Third time revaluation loss. So this revaluation loss, first of all, will be adjusted from other comprehensive income to the extent there is a balance in revaluation reserve. Any excess revaluation loss will be adjusted in P and L. Now, first time we did revaluation loss, P and L. Second time we did revaluation loss, P and L. Third time we did revaluation gain. So this revaluation gain will be recognized in P and L to the extent revaluation loss was earlier recognized in P and L. Any excess revaluation gain will be recognized in other comprehensive income and hence accumulated in revaluation reserve. The revaluation loss of one asset cannot be adjusted with revaluation gain of another asset. Exactly same as that of property, plant and equipment. Now, amortization again is very much same. Again is same as that of property, plant and equipment. Comparison I have done again. Okay, when for property, plant, equipment, when carrying amount differs materially from its fair value, generally once in 3 to 5 years. If fair value is volatile, then annual revaluation is also done for property, plant, equipment. Intangible asset exactly the same, but fair value model can be applied only if active market exists for that intangible asset. Investment property, annual revaluation. Property, plant and equipment, class of asset basis. Intangible asset same as property, plant, equipment. For investment property, all investment property is one class. Entire IP at cost model or entire IP at revaluation model. Okay, now treatment of revaluation gain or loss for intangible asset and for property, plant, equipment is same, but for investment property all the revaluation gain loss goes to P and L. Okay, now depreciation. So even if PPE is at fair value or investment intangible asset is at fair value, so both PPE and intangible assets depreciation has to be charged. But if investment property is at fair value, depreciation ceases. Depreciation ceases. Tell me guys, is that clear everyone till here? Is that clear everyone till here everyone? Come on guys, please tell me. Are you understanding everything? Now, comparison of property, plant, equipment is done with intangible assets and investment property. Now comes the next topic. Modes of acquisition of an intangible asset. Separately acquired we discussed. Internally generated we have to discuss. Self-generated we have to discuss. Business combination we'll discuss with group accounting, not now. Exchange of assets, again I'll say same as property, plant and equipment. Government grant we'll discuss in part of government grant, not here. So now first point comes here is the discussion of internally generated intangible assets. Now let me quickly summarize internally generated intangible assets. So basically in internally generated intangible assets there are three phases. First phase is called as research phase. Second phase is called as development phase. And third phase is called as developed phase. Now, research phase is a phase of gaining knowledge and research. Okay, development phase is the phase of where we develop, is the phase where we start developing. Developed phase is the phase where we start when the intangible asset becomes available for use. When it becomes available for use. Now, how will we evaluate whether the asset has reached the development phase? So we have to see whether pirate is satisfied or not. So what is the meaning of pirate? Pirate basically means probable future economic benefits will flow to entity. There is an intention to complete. We have resources to complete. We have ability to complete. We have technical feasibility to complete. And expenditure can be measured reliably. Okay, this is what is called as starting of the development phase. Now guys, what happens generally, I'll go to the question phase and I'll show you something. I want to show something to you. Intangible assets. Just see something here. See what does the question say. Read this question and you will understand what I'm trying to say. Not this question. Let me take up different question. So basically, okay, I'm not able to find that question as of now, but I'll say what exactly I'm trying to say. Okay, so basically, question will give you the indication of pirate either directly by saying that one of these conditions are satisfied, or question will specify that directors are confident of success. Okay, now any cost incurred before the directors become confident of the success is called research phase. Question will directly say that development phase has started, but ignore that point. Still, let me find that point, because if you understand, you will be able to see it better. Just give me a minute. Yes, see. Asoria Co. had a new project began on 1st October 2007. The research phase of the new project lasted until 31st December. Means the question says from 1st October till 31st December, it was research phase. Now what does it mean? That from 1st January, development phase will start and you will start capitalizing the cost. But now see, how is the question trying to confuse you? And incurred 1.4 million of cost. from 1st January 2008, the project incurred development cost. Now, as a student, you will say, oh, development cost. Let's start capitalizing. Now, from 1st April 2008, the directors of Asoria became confident that the project would be successful. So now, which date is the date of development? 1st January or 1st April? It is 1st of April, not 1st of January. 1st January question is trying to confuse you. 1st April is the exact date when the directors became confident of the success and the pirate is satisfied. So you will start capitalizing your development cost from 1st of April. Any cost incurred prior to 1st of April will be recognized in P&L as a research expense, research costs. Tell me, is that clear, everyone? Is that clear, everyone? Come on, guys, tell me, please. Okay, now, so what is the treatment? Research cost is expensed off to P and L. Research cost is expensed off to P and L. Development phase. Development phase. We capitalize. We capitalize. We capitalize. Now, we capitalize. But will we start to amortize? No. Amortization starts when the asset is available for use. So, amortization will start from this date. Amortization will start from this date. Amortization will start from this date. Okay. Now, but still, since we are not amortizing, standard says that test for impairment. Test for impairment annually. Test for impairment annually. Guys, just 1 minute off the beat, 1 minute off the track. Ideally, there is a standard on impairment, that is IAS 36. Which says that the asset has to be tested for impairment only if the impairment indicators are triggered. But there is an exception to this general rule. What is the exception? That there are 3 assets which has to be tested for impairment annually, whether or not impairment indicators are triggered. Okay, even if impairment indicators are not triggered, these 3 assets has to be tested for impairment annually. Can you name those 3 assets? Can you name those 3 assets? First one is goodwill acquired in business combination. Second one, intangible assets under development phase. And third one, intangible assets with infinite useful life or indefinite useful life. I'm repeating the name of those 3 assets. Goodwill acquired in a business combination. Second, intangible assets under development phase. And intangible assets with indefinite useful life. These 3 assets has to be tested for impairment annually every year, irrespective whether impairment indicators are triggered or not, doesn't matter, but we have to test it for impairment every year. I believe it is clear to all of you. I believe it is clear to all of you. Okay. Now, further, what will happen in developed phase? We'll start amortizing it off. We'll start amortizing it off. Sir, what about impairment? So, impairment, since it is no more under development phase, it has reached developed phase. So, impairment will be charged only if impairment indicators are triggered. I believe it is clear to all of you. Clear? Now, so this is the accounting treatment. This is the accounting treatment. Now, going further. So I have taken up an example to explain the intangible assets under internally generated. Okay, now, so understand this question. So there are 3 years: year one, year 1, year 2, year 3. This is the research phase. So whatever amount is incurred in the research phase, we expense off to P&L. This is the development phase. So what we did, whatever amount that we incurred, we capitalized it. So what is the total amount incurred? 6,900. Now we have to test it for impairment. Since the question is not giving me recoverable amount, I cannot test it for impairment. Hence the carrying amount will be 6,900. Will we amortize it? No. No. Now on 31st March, it becomes available for use. That is, it enters into developed phase. Now once it enters into developed phase, what will happen? We will amortize it over the useful life. So useful life is 6 years. So what is the amortization? 6,900 by 6 is 1,150. So what is the carrying amount? 5,750. Is that clear, everyone? Wonderful. Now, self-generated intangible assets. These intangible assets we have not generated. They automatically got generated. Let's suppose, okay, if I work on YouTube, okay, let me talk it very practically. If I work on YouTube, okay, if I help students in free revisions, okay, okay, so the students who are not enrolled with me can also revise. Okay, so definitely it will help me develop a brand name of my own. Tell me yes or no. Right? It will help me definitely help me build a brand name. Tell me, am I incurring any specific cost to develop this brand name? No, I'm not incurring any cost. To develop this brand name. No, I'm not incurring any cost to develop this brand name. Okay, so now understand. These intangible assets, though it will give me future economic benefits, right? Though it will give me future economic benefits in the form of increased registrations, increased admissions in the next attempt. But tell me, have I incurred any cost? No. So is the recognition principle satisfying? No. Recognition principle says what? Future economic benefits should exist, plus cost can be measured reliably. If both the conditions are satisfied, then only I can recognize it as intangible asset. Here, these intangibles definitely gives me future economic benefits, but there are no cost. So will I recognize it as intangible asset? No. So customer lists, internally generated goodwill, brand name, or publishing titles, all these are not recognized in the financial statements. Okay. Intangible assets acquired in exchange. So it is same as property, plant, equipment. That is, the assets that we acquire in exchange is recognized at fair value of asset given up. It is recognized at fair value of asset given up. Okay, now amortization of intangible assets is exactly the same, so nothing to discuss here. Now, intangible assets with indefinite useful life. Just now I was mentioning these, since there is no useful life, we cannot amortize. So these intangible assets are to be tested for impairment annually at the same time every year. Okay, now these three intangible assets, goodwill, intangible assets under development phase, and intangible assets with infinite useful life or indefinite useful life, since they are not amortized, hence they have to be tested for impairment annually. Derecognition of intangible asset is exactly same as that of property, plant, and equipment. Okay, that is, intangible assets should be derecognized on disposal or no future economic benefits are available. When we derecognize, whatever are the gains or losses on derecognition is recognized in P and L. On derecognition of the revalued asset, any credit balance in revaluation reserve is transferred to that of retained earnings. Is transferred to that of retained earnings. So this completes my discussion of intangible assets. But hold on a minute, We have to discuss few mistakes also. Revaluation model of intangible asset can be opted only if active market exists. Brand name does not have an active market. Research and development phase only after pirate is satisfied. When is the pirate getting satisfied? When is the pirate getting satisfied? When directors become confident of success. Okay, now in annual impairment, three assets. Goodwill acquired in a business combination, and what? Tell me, and what? Goodwill acquired in a business combination, intangible assets under development phase, and intangible assets with indefinite useful life. Okay, so this is what is the revision of these two chapters of intangible assets and investment properties. Now, just give me a minute. Okay. So this is the last session which we are conducting live on YouTube for open for all for free. From tomorrow onwards, this session will be conducted on our portal, not on YouTube live. Okay. So again, I'll just give you details of our crash course. Okay. Basically, in our crash course, we'll be covering three things. Revision of entire financial reporting in 25 hours. Okay. Practice of section A, section B, and section C questions. Sir, what type of questions will you cover here? All the important questions of Kaplan, Study Hub, and BPP will be covered. 6 mock tests, 4 block wise and 2 full-fledged mock tests. Okay, for these mock tests I will be conducting an evaluation session, and for mock test of chapter of interpretation of financial statements I will be giving you a personalized feedback wherein I'll tell you what are the points where you can improve your answers. Okay, plus I will also discuss an examiner report analysis. Okay, plus I will conduct a session on interpretation of financial statements wherein I'll discuss how exactly you need to draft your answers on interpretation, or what are the key techniques for drafting answers of interpretation. But from now onwards, the session will happen on our portal, not on YouTube. So if you want to enroll in this revision batch, you can enroll by the details are shared in the description of this video. Still, if you want me to share the details are, you can call on this number 84313 84051. Okay, or you can directly visit www.bbvirtualsglobal.com and you can enroll for this FR crash course or FR revision course batch. Okay, if you need any details or if you need any support, you can definitely call on this contact number or WhatsApp on this contact number and get the details of the batch, and see you in the class tomorrow at 2 p.m. in our portal. Thank you guys. Bye-bye.